Good morning, good afternoon, good evening, everybody. Welcome to this episode of the Note Closer Show. As always, Scott Carson, excited here with you today. I'm really excited for this special guest I've got here today. I know that many of you of our audience is either in residential or they're also in the commercial space, or you're looking at going to one of the others, or you're starting off in residential, looking to go big into commercial. Well, I've got an expert who's done both, is in both, basically straddling the real estate fence in both the residential and the commercial world, and doing a great job about it. He's a real estate entrepreneur with a history of success and a commitment to doing what it takes to get the job done. He's a wide range of experience in real estate, and he specializes in finding the best real estate investments for his investors. And we're talking about the man, the myth, the legend, Mr. Cory Mortensen. Join us here on the Note Closer Show today. What is going on, Cory? How you doing today?
I'm doing great. Thank you so much. It's an honor to be on the show today, and I'm excited to drop some knowledge for your audience.
That's right, baby. I didn't go to Texas Tech. I got plenty of friends that are, a Red Raider up there. I'm sure you're excited today. Cliff Kingsbury is going to be coaching at USC. I just saw.
I know it's a crazy year for Texas Tech athletics, but that's what it's all about. We're the underdogs, and there's always something to talk about.
That's right, baby. That's right. Well, let's dive into. You've got. Let's share a little bit of our listeners with you about your background, kind of how you got to where you're at today and got started.
Sure. So I'll kind of get everybody caught up with my background. And so went to Texas Tech, graduated with a degree in finance with a commercial real estate cohort, and that is an investment banking style degree for commercial real estate. And that gets you prepared for really the corporate world, corporate commercial real estate, institutional real estate. So that was a perfect degree for me and what I was looking to do. I had kind of jumped around with what I wanted to do. I knew it was going to be business. I knew I wanted to be an entrepreneur, and pretty industrious after graduating. So I fell in love with real estate, and that program really launched me into everything that I'm doing now ever since I graduated, which doesn't seem that long ago, but it's getting longer and longer. But yeah, no, I started as a commercial real estate appraiser with Travis County. And that was a great position in really learning how public municipalities look at data, look at the appraisal side of things, because I haven't really heard many interviews or talked to a lot of people that come from an appraisal side or even understand the appraisal side. I think, they get the ones and twos of they're going to, take a look at comps and things like that, but to really see how it happens. And you want to know the funny thing. So there's, hundreds of thousands of parcels of commercial real estate in Austin, Travis County. How many people do you think manage that?
Oh man, I would say it's not nearly like on the residential side. It's probably a smaller amount, huh?
11. I was hire number 11.
Wow, that you have to go around and appraise all that stuff in
Yes.
annual basis.
Yes.
Wow.
Yeah. So everybody has their in this department, and it changes all the time. But when I was there, and I'm going to move past this quickly, but everybody's got their own section, their own asset specialty. That way, it just is easier because everybody's dealing with the same comps. They're very familiar with the owners, the assets year after year, and it gets assessed every year here in Texas. And so you have a lot of systems to get that done, and it's done by data. Travis County was very pioneering in its data management and how it pulled comps and came to assess values to meet the sale value. They're guessing, right? They're shot in the dark. But anyway, that was my first job out of college, and then I moved into investment sales with a regional retail brokerage, and got my cut in that with talking to owners, really getting into the nuts and bolts of what it takes. And I learned more with that, and those skills translate more to what I'm doing now than anything and they didn't have any CRM. I got sat down at a desk and said, do investment sales at 23. And I had a blank desktop, went out and found, just drove around, just taking notes of addresses. And it was, your corporate retail, commercial real estate. So any brand name, any store, any restaurant, those types of assets. And then did that for about a year, and then moved into, I needed more of a culture fit. It was a, total doghouse in there. And I was really eager to learn, and nobody was really eager to teach. And so I really just needed something that was going to fit more my personality. And my friend introduced me to the residential brokerage that I'm at now. And I absolutely love it. It was a perfect fit. I joined that residential brokerage in January of 2020. So perfect time to jump into an asset that you have no experience with and have absolutely no clientele or business. Because I'm from Lubbock. I have no friends or family that are purchasing homes at that time. You know, in our lives, we're in our young 20s and nobody can afford to go 100K over on a house. So
Especially here in Travis County, that's the truth here in Austin.
yeah, exactly. Premium Texas market. So I hustled leases for about a year and just trying to get, you know, a pipeline drawn up and was, you know, learning every day. And then finally got going. And I'm in my third, almost fourth year at this brokerage. And last year we launched what is now our bread and butter, our commercial syndication. And that's, you know, I feel like we're going to talk more about that than anything. And that is really my dream. That this is going to be my, you know, my next stepping stone that is hopefully going to be a legacy for me and my family and everybody around me. So working really hard at it. We've been a year into it now with the LLC, and right out the gate, we raised 1.5 million for a developer, 300 unit mixed use affordability component here in Austin. And so that was really great. We got that done with a couple close connections. And then we consulted with a high net worth client to advise on their $3 million of real estate capital for investments, development in the Sun Belt in Florida. What else? Just kind of done a couple other deals. We were just, you know, we had a bunch of people who had money, and we had a bunch of people who were doing deals. And so we just acted as, you know, the middleman and putting people together. And we just took fees on both sides, and that gave us a budget for marketing and legal to go out and hunt for our own deals. And we really started looking at our own deals in the summer of last year, 2022. And as you may know, that was pretty much the peak of the market. And so we really know our numbers. And so while we were hunting, we were mostly looking at on-market deals. So we're already at kind of a disadvantage in terms of pricing and competition and things like that. But we got really close, and I'm talking, you know, seller's first choice or second choice on, you know, 100 unit, a 200 unit, a couple 60 units, a couple 40 units, but just couldn't get to the pricing. Our terms and our relationship with the groups was the best, but our pricing wasn't. And I'm actually proud of that. You know, we haven't pulled down our own syndication deal yet. We've only done partnerships and raises in the past, but I'm actually proud and to tell people, no, we haven't bought a deal because a good enough deal hasn't come across our table yet. And we're not just going to take an acquisition fee and run away and hope a deal, you know, checks out with appreciation. You know, we're really dead set on getting a safe deal and a home run deal. And if I can't go to sleep at night knowing that my investors and I are going to make money, then I'm not taking that deal down. I'm not even going to look at it. So that's a long-winded response to your question, and brings us up to present day. So
Good stuff, but I want to shed a little light on stuff there. Have you gone back at the deals that you nearly missed out and are glad you didn't close on them, or seen how the market has changed some with pricing and all the chaos, and especially in the commercial markets right now?
Absolutely. Those are the deals that I'm going to call on in 2 years because they're going to need some debt.
Why, for our listeners out there that's watching, can you explain why that is? What's causing those deals to be in trouble in a year or two or stuff like that?
Yeah, absolutely. So what we were competing with was the absolute peak in pricing and the lowest amount of interest rates. They were trickling up. I think, you know, they were probably in the 4s and 5s when we were making those offers at that time. And we've been making offers the whole time, right? So we've seen the interest rates go up all the way to where they're at now, you know, all 8s, 9s, you know, in some cases. And so what we're going to see is those low interest rate buyers, when they come with their short-term debt, you know, bridge loans, renovation loans, you know, whatever your term is, they're going to be in a much higher, maybe even double or triple, depending, interest rate environment from where they bought it. And I can tell you, a lot of these buyers, we're not accounting for that. And so that completely takes out your cash flow, your debt service. And also with the banks, Silicon Valley going under, there's a lot of eyes on the banking industry and everybody's kind of holding their breath. So that also hurts your lending side, because whereas normally when things are going good, they'll give you better terms, but now they're really tight. And even if it's a functioning asset that covers that debt service coverage ratio, even by a mile, some banks are just not lending because they're worried. And so there's a lot of different things happening. And that kind of goes back to what we were talking about before with that moving target.
Yeah, especially when you see interest rates increasing, like I said, double, triple, that reduces cash flow, which reduces your NOI, which reduces your cap rates, which reduces the value of the asset. And those institutions or companies or LLCs that bought those are probably going to have to bring a substantial amount of cash to the table on a refi, right?
Yeah. To come full circle with that question, and why I'm going to call on them in a couple of years is because, most of these short-term loans are only 3 or 4. Oh, I'm sorry. I got these dogs out here.
It's all right.
Hold on one second. Anyway, sorry about that. So yeah, going full circle on that question, they're going to need debt. They have these short-term loans that are 2, 3, maybe 5 years, interest only, and they're going to need a new loan or some kind of new money at that time to either refinance the investors, refinance the property as a whole. There some reason they're going to need debt on there. So what we're going to come in and do is, our hope when we call these people is that they're going to need somebody that's going to come in and help them out. They're going to need an injection of cash. They probably haven't gotten the returns that were promised to the investors, which gets a little tricky. And when you've got operators who have investors breathing down their neck, we might be in a position to take the price that we finally wanted, or whatever terms that work out. And we're not looking to gouge anybody. I mean, this is an opportunity to help people out of a tricky situation where they could just take a complete loss. I mean, ruin the relationships of their investors and their company and things like that. So these are opportunities for other syndicators and other commercial people to come in. It's just an opportunity. There's so many opportunities that come up all the time in the ebbs and flows of the market. And so we're hoping to take down some deals in that way.
Yeah, where you coming in with a chunk of cash to help write down the loan, and then either getting a large piece of the action or maybe taking over management of the asset in some cases. Are those two the different strategies for you at that time?
Yeah, absolutely. And I tend to ramble, so thank you for summarizing.
Okay, no, it's good. It's all right. It's good. You and I speak the same language. I just want to sometimes make sure our listeners know what that kind of means.
Yeah, no, I like to give a lot of detail because in my efforts to talk to people and learn, everybody seems to be very tight-lipped. And even when they are trying to be helpful, they don't really explain it in a clear-cut way. And so when I'm talking to people, I'm so excited about. I mean, I love real estate. This is what I'm passionate about. This is what I'm going to do for the rest of my life in one way or another. And so I'm super excited about being on the show today because I can talk about this and I can explain it to people. But yeah, there's a lot of opportunity right now in the commercial real estate space, in the residential real estate space, in the note investing space. And if there, do you have any other questions or anything?
Yeah, no, definitely. We definitely got quite a few here for you. Where with what you've seen changes, what changes have you made to consider that interest rate risk or depreciation risk in the underwriting process or what you're looking at?
Yeah, so that goes straight to our underwriting. And kind of what I was saying earlier, we were really conservative before, and that's why we didn't take any deals. Now we're taking what our already conservative assumptions were and just completely leveling them and even backtracking in a lot of ways. Some people were advertising that they are underwriting for large rent growth. We are no longer underwriting for rent growth. That could change in a month, next week, 6 months. But right now we are extremely conservative with rent growth because in a lot of areas, and we kind of focus in Texas, we love San Antonio for its growth market potential. And, those lower price point areas and lower tenant demographics and things like that, where they're just not, the average household income isn't as high as some other areas like Austin, Houston, DFW, those markets get hit with rent decreases quicker. Just basic socioeconomics on that. And so that's why we're not being aggressive with our underwriting ever, because I want home runs on every single deal. And it's just protection. We're facing down the barrel of a recession if we're not already in it. And you have to make investors feel safe and comfortable with an investment, because we're pulling a lot of money. I mean, we're talking millions of dollars. And so they need to know without a shadow of a doubt that they're going to get that return. And with everything going on, there's a lot of changes. We're not underwriting for rent growth. Our cap rates are decompressing. Some brokers have even told me it's unrealistic. And, I would quickly turn that one back on them. I still I've looked at some broker OMs that are underwriting for 4 caps, and, that's tough.
Well, that's the thing, is if you're especially leading into where we're at, history doesn't really repeats itself. And if they're talking about the commercial space being a bigger deficit, or I won't say time bomb, than what the residential markets, I've seen some people come out and say, hey, it's going to be tougher than what we saw in the residential markets 2000. And I think it's all dependent on market specifically. But when you look at, like you said, those geographic areas where income is a little bit more stable, pricing a little more stable, him see the big run up on values, you've got to be really conservative. I mean, most of the time, if you're buying a distressed asset, you want to be buying at a higher cap rate and selling on a lower cap rate for the most part. And, I used to laugh that a 4 cap, people in California would slice their grandmother's throat to make a 3 to 4 cap. You know what I mean? Texas has gotten that kind of crazy in some cases. That just doesn't make sense in a long-term basis,
Absolutely agree with that. It's really just being conservative. It's being smart. And it's talking to people. We have a huge network of other syndicators, other operators, lenders, everybody. And if you're not talking to these people on a weekly basis, you don't have the best information and you are not making the best decisions. And in this, people think real estate, it is a long-term game, but you have to be in the know on the short term, and you have to know what's going on in the trenches, literally. I mean, it's tough out there. And if you are underwriting with the wrong information, you are 100% setting yourself up for, I would say, failure, but some very heavy surprises.
Yeah, very heavy surprises and decreased values and over encumberness. Have you talked with any folks that have already started to have the banks start to do capital calls on values drop and stuff like that? You seen any of that happening in the market in your network?
I haven't heard too much of that. I'm sure it's happening. I just haven't heard of it. What we are seeing is, banks requiring bringing more equity to the table. The loan to value and the loan to cost ratios, which were generous, even just 6 months ago, are now getting a little less lenient, and that does 2 things. That makes a raise a little bit more difficult, just because you have to bring more money, talk to more people, potentially more legal paperwork with more parties, depending on your syndication structure. But it also dilutes the leverage and in-hand your returns. And so everything is making an already hard syndication structure that by nature needs a discount to, institutional and in-house buyers even tougher. So it's tough out here for us.
What kind of LTVs have you seen in the past when it comes to the multifamily side? Is it 65, 70, 75, 80%? What's I know it's specific about an asset and what's going on, but some ballparks for our listeners.
Yeah, ballpark, we're talking, 6 months ago when everything was bright, sunny day, it was 80% loan to value. I even had one quote me at 90%.
Wow.
I wouldn't do a 90%. Some people think that's the best thing that ever could be offered to them. Don't take the high leverage. That sets you up for a lot of risk. Unless you really know what you're doing. But anyway, yeah, 90% was the highest. 80, 75 was really normal. Now we're seeing pretty healthy on the 65. Feel like I got to really twist an arm for 70% loan to value. And loan to costs can be really all over the place. I mean, those have stayed a little bit more, because we were getting, 80-85% loan to cost before, and you can get those a couple of times right now, but it's a little bit low. I'd say that's not as low as the loan to value. You can get maybe 70-75 on loan to cost.
Where do you see, as far as class of the assets, as the biggest opportunities? D to a C, or a C to a B, or a B to an A, or an A? Where do you see the opportunities the most being for folks?
Now, this is the part where I turn into the person that I hate to hear from, because it totally depends on who you are. A D class asset, and I don't think I've even really looked at a D class asset. Those don't come up too much in the Texas markets unless you're in some tertiary markets.
Rough. You're in some rough
Yeah,
areas.
you gotta really find it. So, but if you want double digit, returns out the gate, cap rates, you can go and find a D, but you got to put up with a lot and be able to be really hands-on and have thick skin. C class is what we focus in. We want a C class in a B class area. But what I've really started thinking about, and even just this week, I was kind of posing the question was, how long can a C class asset, we're talking 80s, 70s, 80s vintage, really survive? Because, it's picked over. It's, everything we look at has really changed hands in the last 4 or 5 years,
Right.
A huge chunk. So they've been renovated, and you have this huge influx of new product. You've got the B class that was built in the 2000s and late 2000s. And then you've got your A class that is, being built out in a huge demand right now that's coming in through the pipeline. So my question, and this is for everybody and nobody has the right answer, is what's the future of the value add syndicator, the value add investor, and the value add asset? Because you can only change the paint and the floors so many times. It's an asset that needs to exist, just because all different people make all different types of money, and it's something but you're always going to be capped by the thing above it. You can't charge B class rent in a C class asset. You can't charge A class rent in a C class asset, or all the way down. It all trickles down, and there's ceilings to everything. So you have to pay attention to what's going on in the pipeline, because you kind of have to, with the lag of real estate, you have to see what's coming through and compete with that, because you have to know your demographic of who's going to rent this asset and how much they're going to pay.
Yeah, it's especially important because the A class sets the ceiling in a lot of cases. Now, you've seen a lot, especially like here in Austin, what was it, average of 40% rent increases across the board in a lot of cases, because of the huge demand and low supply, but a lot of build out taking place. But that B class, those folks that can upgrade are glad to go someplace new if they can get at or a little bit more for what they're paying, what they're expecting, right?
Right. And it's, and it kind of goes back, and it's this funny catch-22. And, renters, those that have the mindset of like, oh, I don't want to rent, I don't want to have to pay a mortgage or property taxes and things like that. You're paying somebody else's property tax, because when they get a property tax hike, you get a property tax hike. They pass it on to you, because they got to make money. They're going to hike your rent when that occurs. So there's so many things that affect it. And like I said, you just gotta have to pay attention to what's going on around you, and not just have a tunnel vision with what you've been doing.
Yeah. Now let me ask you on another side of commercial real estate. Apartments have been the upper echelon, the creme de la creme asset, really the most overpriced asset for the last few years. Let's talk about some of the other classes, hospitality or mixed use or other things that have struggled the last 3 or 4 years. Especially like office, sure you can buy a mall for 50 cents on the dollar right now, but you may not know what the hell to do with it, right? These days.
Yeah, I think the question is, what can you do with these assets? Because what they have been previously and traditionally isn't working. It's not working right now. It might work in the future, but what does the investor who owns or is looking at these assets right now do with it, or turn them around? How do they turn them around? And I think this is where, and I want to get into this so fast. Personally, on our own investing, we're going to have our stabilized portfolio, and then when we have some play money, I want to go and touch these assets, because the thing is, that's a high risk, high reward situation that I think is going to benefit the true entrepreneurs. I think the institutional people, and forgive me, but I don't think they have the creativity to see and hunt for where the opportunity is for that. And I think that's going to take a look at location, what's around there, who are the people, what is the space physically capable of, what do you want to do with it? What would somebody like to see here? Even if it's not zoned for it. I think that's a really fun Wild West that I'm excited to be a part of in the future.
Yeah, we had a few colleagues that we know of that, especially right as COVID came out. One had just launched a new hotel at the literally week before COVID shuts down. Well, he was very quickly converted that to an apartment complex, and another guy had an executive office, and he basically converted it to an executive office storage facility that got full of just office furniture from all the other companies around him that were closing their doors. You know what I mean?
Right.
Big box converting that into self-storage or vacant gyms. I know that somebody's talking about turning the a vacant Gold's Gym here into potentially apartments or affordable housing for homeless in a lot of cases by putting little pods in there. You get you hit the the button right in the hit the runs right in the button with it. Hey, got to know what's going on. What can you get approval for, and what's really needed in that zip code of that city more so than anything else, right?
Yeah, and I feel like that's, if you're an entrepreneur and you want to take something like that down to where you're doing a non-traditional use in an old traditional building like a shop strip center, or whatever it may be, warehouse, that's something that if you can come up with a really fun and exciting plan that works and benefits the city, you'll have a lot easier time with it, because the city is going to get excited. That's the number one thing you're probably going to run into. I mean, you can get everybody else on board, but if the city's not, you don't have a snowball's chance.
Yeah. What's the biggest thing that you see? Because with you having your feet in both markets, residential and commercial, what's the biggest difference in the two that you have to adjust for? Is it time of a deal? That his commercial has a lot longer lag time when it comes to underwriting and getting something approved versus a residential, which is pretty fast in most cases. But capital raising, what's been some of the biggest tips that you give those out there looking to move from residential to commercial?
Yeah, tips for people who are in residential and looking to move to commercial. Just be authentic, be personable. People think it's funny because I started in commercial, went to residential, and the realtors that I work with think that I have like some God-given superpower and knowledge, and I'm an idiot. I'm figuring it out every day too, right? But no, it's all
Hey,
about
I
just
don't think you need to have that in your pitch to investors. Hey, man, I'm an idiot.
no, I mean that I'm learning every day, and it's something that just have a humbling message for people that, these people don't know everything. It's just a different set of knowledge. You hop on to, Udemy or, LinkedIn has a bunch of commercial courses. You can learn how to talk commercial and look at a commercial asset in a week. So, that's a piece of advice, just go hunt for the education. There's a ton of free assets and cheap assets out there to go and find and learn. Find somebody that get a mutual introduction. You're not going to get anywhere with cold calling and saying, can I take you to lunch? And, how can I add value? Figure out how to add value to them, and that's going to be working for free and probably making some cold calls or bringing rich people to them, money, assets. That's going to get you into a room that you quote unquote shouldn't be in faster than anything.
Now, what's your tip for raising capital in today's crazy market? Doing a lot of presentations, marketing to IRA investors. What have you found has been effective in reaching out? Because the conversation has changed than what it used to be. But let's not talk about that. But what are some of the best practices that you guys have implemented to raise your capital?
Yeah, that's 100% relationships and feeling out people. People are going to only put money with people that they trust. They don't have to know you, but they need to trust you. And you need to have a way of presenting your business plan, your deal in a way that makes sense. These people are sophisticated. They're smart. they got to where they're at for a reason, and they can sniff out somebody who doesn't know what they're doing really quickly. And so it's all just about having all your ducks in a row, knowing what you're talking about for the most part, and being personable. And the most important thing is understanding their needs. If they want something that is, they want cash flow every month, they're not going to buy a development. They're not going to put money into a development deal. It's kind of just matching needs, and in that respect.
Yeah, that's good. Is asking questions, because some people right now are more worried about, as I've heard people say, it's paramount that their principal is safe or secured in a lot of cases. That's one of the best things that most people don't want to lose on their principal. The growth,
Yeah,
the like and trust is very important, but it's paramount that their principal is secured in a lot of cases. So if something does happen, everybody understands shit'll hit the fan, but hey, if at least what I put in, can I get that back at some point?
exactly. And that's why it's taking a long time for us to get a deal. And we've looked at some great deals. I mean, deals that I would recommend anybody buy, but I need a guaranteed home run, basically. And so that's really just going back to our conversation about being conservative and having the right assumptions. Now, I'm not saying over assume or under assume, however you want to look at it, yourself to death, but you need to be able to say to your investor, I got you. This is going to be a safe investment. You're going to not only keep your capital. Nobody should be investing their life savings, by the way. This is their grow money, their
Yep.
family legacy money that they want to grow and grow and grow. And so they don't want to see it go. And you need to have measurements in place with your underwriting and your deal to say, we're going to not only make money or not only keep your money, but we're going to make money on this with everything but a guarantee. And so it's just being conservative and having a good team.
Yeah, when you're talking to high net worth individuals and they understand that you're looking for deals, you're selling them on your, I don't say theory, but deal focus. I'm sure you probably got a pitch deck of some sort or something, talk about what you're looking for. What kind of commitment are you getting from individuals, and how long are they usually holding on to capital to place it with you? Is it immediately going in an escrow account for you? You're holding it and having them hold on to it till you're going under contract, or how's that kind of working, Corey?
Yeah, we'll do a fund structure later on when we've got more volume and an acquisition team. But right now, it's just me and my business partner doing everything. And so there's no need to be taking money. I don't know when the next deal could come across, especially with how things are going in the markets all over the place. So I don't want to tie up their money and, for longer than it needs to be. But in terms of, we talk to these people, we say, hey, here is what we're looking for. Here's kind of our deal structure. Here's a sample example of what exactly we're looking for. Here are the returns that we underwrite for. We don't touch anything that doesn't hit these 3 check boxes and then some. Is this something you would be interested in investing in today if we had it? And they say yes or no, or they ask questions and we ask questions, and then we say, great, that's perfect. What would be a minimum investment you'd be willing to make? Or, what's a range for you if it's a, whatever. And we kind of just take that as a mental note, put it in our database. And when we come up with a deal, we chalk it up and come back to them and say, hey, we've got something for you. I want you to take a look at, and then kind of start the process over from then.
That makes sense. I mean, that's just, I know we got folks asking, well, hey, if you're raising capital, but you have a deal, how hard is it? And that's a nice thing. It's a little bit different about commercial and residential. Residential, things are moving a lot of fast. Hey, we need you to put money up in 30 days to 45 days if you're going to find a deal. Commercial, you get a little bit more time in raising capital and hunting a deal, then doing a capital call to your investors. Hey, it's time to pony up to come to the table and get stuff going there for you.
Exactly. And we're dealing with, both non-accredited and accredited investors. So there's a lot of things that go into place before we even get the deal across our table. So there's, you can do a fund structure to where you can talk to people and have them wire money. I find that people are much more apprehensive to do that, especially if you don't have a long track record. And that's actually not our biggest objection. You would think it's really just about the deal. And so when you're raising capital, it just depends on who you have ready to go and how quickly they want to move and how quickly they want their money back. And to get back to that question, how quickly people are wanting their money back, the deals we look at, you could have gotten away with a 3 to 5 year timeline. And I think if you get a slam dunk deal, that's possible. I don't think it's going to be as normal as it was, especially just because values are leveling out and you're not going to get the returns as quickly. So I think a healthy timeline, and this is how it always should be, or how it always traditionally was, 5 to 7 years, and 10 years if you've got patient money. So I love a 10-year hold, because that's much safer, much easier. But yeah, we're looking at 5 to 7 years.
But that's good though, because we know in a 10-year time, you're going to have some ups and some downs, and definitely gives you that stability. So it's not a knee-jerk reaction. Hey, this is a temporary blip in the market, or it's gone up for a little bit. We're going to ride it out. We have this figured into our underwriting, and as long as everything else stays the same, we're okay. Get riding through the blip, whether it's an up or down in a lot of cases.
Yeah, and that goes back to understanding the investor's needs. And if they're saying, "Hey, I need a 2x on my money in a year or two," me too,
Yeah, who
But we're
doesn't?
talking
Who doesn't?
about,
But go to Vegas, put everything on red or black.
right.
You know what I mean?
Yeah, exactly. I mean, we're talking about real estate here. It takes a while for things to happen. There's a huge lag effect always. So you need a little bit more patient money. And if you have someone that you're talking to, and say they're the only person that you're talking to, and they have all the money that you need, but they need it back immediately, if you can't find deals that can be flipped so fast, you need to feel comfortable with saying, "Hey, it's probably not a good fit." When we come across something, we're going to keep you engaged, we're going to tell you what we're doing, but it may not be the best, because we're going to be probably around 5 years. We can get it done in 3 years. That's awesome. Bonus, under promise, over deliver all the time. But we're going to be looking at a longer timeline. So let me know if that works for you.
Right. And let me also ask on the side thing, have you kind of ratcheted down what kind of preferential returns you're giving folks to something a little bit more in line with the market as well too?
Yeah, I mean, it depends. Investors are funny. Some people only want 6%. Some people want 30%. It is totally all over the board and depends on their experience, what they've gotten. I think there's going to be a re-education for investors, especially if they're used to making investments into syndications, because they've gotten 2x, 3x, 4x, 5x on their money in 2 years, the last 5 years. So it's going to be expectation management, maybe not re-education, but expectation management for them. And I'm more than happy to, tell them, say, "Hey, this is what we're realistically looking at. I'm going to do everything in my power to knock it out of the park sooner. But realistically, this is what we're looking at in terms of returns." And they can either be fine with that or not. It just depends on their expectation and when they're ready.
Well, that's the thing, and it comes to knowing the market. You can have those great returns, and anybody, their dog can make money on a market that keeps going up. But when we see that turn, like we've seen and coming down, it's the longer term operators that have the better things in place, that understand the nuances of that asset class, the markets, and what's going on Wall Street too, of educating the clients. Hey, we're here for the longer run. This is a longer term investment, not a get rich quick scheme in a lot of cases. We've played this out to do this, so let's not worry about an article that has everybody run into the bank to get their money back. You know what I mean?
Exactly. No, you're 100% right on that. And the return structures, they do change, and it's a deal by deal basis when you're taking a look at that. And so, when we underwrite, I just do a flat 80-20 just to see if it pencils out or gets close to it at that point. And then I'll play around with the waterfall or the structure or whatever we need to do, and see what might work for the deal. Because some deals cash flow better than others. They cash flow at different times. Renovation budgets, construction budgets, there's a lot of things that go into making that structure. But investors are used to it, especially if they have experience, and if they don't, then you just outline it for them and say, "Hey, this is what we're looking at."
That makes sense. What's the best way for our listeners to tap into what you're doing, your deal flow, or see about investing with you, Cory?
Yeah, so we put a ton of education and material out on our Instagram, 19 Holdings, and our Facebook page. Our website is great, so 19holdings.com. So give us a look up, give us a follow. We'd love to put some information on your feed.
Yeah, we'll definitely put those links to the website and the group stuff like that in the description there for you guys. You can click on that and connect with Cory out there. Uh, Final piece of advice for our listeners out there looking to pull the trigger: be patient, know their shit, or jump in head first.
Yeah, yeah, exactly.
Good stuff there, Cory. Well, thanks so much for coming on the Note Close Show, man. Appreciate it.
Thanks, Scott.
Awesome. All right, guys, you heard it here. Great stuff, great information. Don't be an idiot, but be smart in what you're doing. Take the time to understand the differences. Add some value add if you're looking to get your feet wet the first time, but definitely there's some opportunities coming. Just got to be patient and know what the heck you're looking at and know how the market's going to change. Don't just rely on one feature that just good 2 years ago, like a lot of operators have been. The market's changing. You got to keep up with the changes so that you come out smelling like roses instead of smelling like shit. So go out, take some action, everybody, and we'll see you all at the top.